This episode of Climb Aboard Podcast was recorded at the Park Redland Properties in Rockville, Maryland.
My name is Caron Kinsey Prideaux. Welcome back, climbing on board with this webinar and podcast. Today on episode 4, we're going to be continuing our discussion with Ian Shemer from Embrace Home Loans and demystifying the lending process. So thank you very much, Ian, for coming back. I appreciate it. I'm going to pick right back up where we left off, if that's okay with you.
Yes.
All right. One of the things that I want to touch on is, how does a borrower know that they're getting the best rate? Should they go online and hit up Rocket Mortgage and try to apply at lots of different places? Or how can they compare what you might be telling them to other rates when they're shopping the rate?
That's a great question. And I highly encourage that person to go around and have the same conversation they had with me with other lenders, because not only do they want to see who's offering the best rate and who can get them to that ideal payment that fits their budget, but ultimately it's a big purchase. You want to make sure that the service of the whole process is up to your standard, and you can really trust and rely on that person to get you the information and get you the information fast.
Well, how does that happen when you're not supposed to be able to pull credit so many times? It dings your credit every time somebody pulls it. So how do they compare the rate without having their credit pulled to where you see that and you're like, yeah, no, I can't, your rate's going down as a result of so many pulls?
Yeah, so
it's a fine line, right?
So having that conversation with multiple people is definitely a good way to start out. But once you really think you've kind of narrowed it down to a few lenders, it's okay to have your credit pulled. And in the mortgage industry, you have per se a 40-day shopping window to have your credit pulled.
Is that right?
Yeah, which
okay.
allows you to shop for the best terms without affecting your credit.
Okay.
So, if you're shopping, 2 to 3 lenders, great. But if you're shopping 4, 5, 6, 7 lenders, then
bit different.
Then you'll start to see an effect. Yeah.
I know that I tried with my refi and it actually worked against me, but there might have been other issues. So thank you. I'm not sure what happened with me, but so that's good to know. I've heard in the industry a term called overlay, and let me just explain it a little bit to how we see it and interpret that for a second. When a borrower comes to getting an FHA loan, just a regular FHA loan, FHA themselves does not have credit score minimums, let's just say, for one entity of that. They put out to the lenders the product, right, the loan product, but they don't specify the borrower's minimums. Then a lender goes, or a loan officer, puts an overlay over that and says, okay, but we are going to put in some minimums, and in order for us to sell it to our investors, we need to have a minimum of 620, right, credit score. How does Embrace do that when they advertise that they have no overlays? Please explain that process with your company.
Yeah, so with my company, like you said, the overlay is the requirements applied by a lender. And when we have your loan, we run it through our automated underwriting system, whether it's DU or LP.
DU?
Those are our automated underwriting systems through
Okay.
Fannie Mae and Freddie Mac.
Okay.
And those, when they provide the results of the underwriting decision, it will give us a base requirement. And for FHA, that base requirement for purchases is a minimum FICO score of 580, and for purchases 580 and refinances it's 600.
Okay, so it does shoot it out to you from your system in-house.
Yeah.
And so it's not really an overlay, but
Exactly.
I guess it wouldn't be considered an overlay at that point.
Exactly.
Okay. All right. I was often wondered about that because it does have a significance for folks that are trying to justify the FHA versus working with the lender. Can someone go directly to FHA to avoid that?
No, you'd have to go right to the lender.
You have to go to a lender.
Get qualified for that type of loan.
I think I knew that, but I just thought I'd ask. Do you hold the loan? Does Embrace keep their own loans in-house?
Yeah, so we hold all our loans in-house.
Okay.
And so if someone wanted to come and they did their original purchase loan with us and they went to FHA and wanted to come back and do a refinance, we wouldn't hold them to any minimum credit score.
Okay.
Yeah.
Why would someone want to refinance an FHA loan?
Well, people actually tend to refinance when they purchase a home. They may refinance up to 3 times while being in that home in the next few years. And why might someone want to refinance that particular FHA loan?
Mm-hmm.
The reason someone might want to get into an FHA loan in the first place is a low down payment and rate. So when you refinance and we hold your loan, we can do what's called a streamlined loan. We may not need an appraisal, don't need to check credit. We know your income, and it's just it's called a streamlined loan. It's much more smoother to and easier to refinance and save money because rates might have dropped or that person's might want to do some home improvements or repairs and that may be the
cash out a little.
Yeah, and get some cash out. That may be the smoothest way for them to accomplish that.
Do people tend to refinance FHA loans because of the MIP, the mortgage insurance protection that FHA has? It's a lifetime, right? Lifetime of the loan.
Yeah, that
so it never
stays
falls
on there.
off.
Yeah, so I wouldn't say people refinance to keep that. I would say a lot of the cases people would refinance once they have paid down their mortgage to 80% or below, and even if they're a little over and their property is appreciated in their area, they might want to get into a conventional loan and get rid of that mortgage insurance, which could save them tons of money on their month-to-month payments.
That sounds good. Well, I want to just kind of go over with you some scenarios.
Yeah.
I'm not sure how you'll react to this, but let's try it out, okay? So scenario 1, a borrower is interested in purchasing a lot and building their own home versus buying an existing resale home. Walk us through the lender's side from what we need to do or what the lender is requiring, especially what Embrace might be requiring.
Yeah, so for a pre-existing property versus a new construction home, virtually the process from a lender's standpoint is not different at all. The biggest difference is that the home is not built. You can't live in it yet when you want to buy a new construction. So we can have you fully approved in the same timeline as any other purchase, but you can't go to settlement, sign off on that deed and that note until that property has been built and inspection has been done and you have been cleared to live in that property.
On the deed of trust, they can't.
Correct.
There's nothing to sign for, right?
Exactly.
If somebody decides to buy the new home, what type of loan products do you have for that?
So in our previous episode, we discussed our extended rate lock program that allows you to lock your rate all the way up to 360 days with that free float down. But in terms of programs, we do any of the conservative programs that the other lenders and banks do, your conventional, your VA, your USDA, and FHA loans. But like our last episode, we talked about the self-employed borrower. we might need to get them into a beyond product based on their specific situation. So,
Is it considered construction? Is it a construction to permanent, as I've heard it say?
Yeah, we don't do those in Embrace, but
Okay.
based on the new construction, we can do any of the products we offer.
So you
here
can
at
offer
Embrace.
a conventional loan.
Absolutely.
It's just not on a pull system
Correct.
like construction loans
Yeah.
are typically.
Exactly.
Understood.
Yeah.
Okay, now I
That
get
makes
it.
sense.
Okay, so they have the longer rate locks for those scenarios.
Mhm.
If somebody wanted to build on an existing lot or whatnot, they would just get a regular loan,
Yeah.
regular conventional loan, conforming, all of that.
Exactly.
Okay.
Yeah.
Good to
Whatever
know.
best fits their circumstance. Yeah.
Yes, I understand. Okay, and scenario 2, here we go. A borrower is an investor and wants to purchase a fixer-upper, right? What does that look like to you, the lender, when you hear the term, I want to buy a fixer-upper and resell it after I've fixed it up? What does that look like to you as a lender?
I automatically have a light bulb in my head that goes to our renovation loans, our home style or our 203K renovation. And depending if that person's looking to make an investment property or it's going to be a second home, then home style is the way to go.
So even as an investor, they qualify for that?
Correct.
Okay.
But if you're going the FHA route and want to do a 203K loan, then you are you can only do that type of loan to a subject property, your current residence.
So it would have to be a primary
Primary
residence.
residence.
Okay, so it wouldn't be for an investor.
Correct.
That would not be. So
So
you
only
could
our
do
home-
it the home style.
Home styles.
Okay. And with that home style, if you were to do that, would that require a higher rate than, say, the 203K?
Not necessarily.
Okay. Good information.
Both programs are very competitive.
And how long does that type of program run for an investor?
So I typically will say 60 days is the time frame to expect.
Okay.
And for that reason is that borrower needs to hire a contractor who's willing to do the work, and that's typically where that time frame gets elongated. It's just the shopping for a contractor that's willing to do the work there for you.
Mm-hmm. If they already have the contractor lined up, though, does that save some time?
Definitely makes it. Yes, it will definitely save some time.
Does the contractor have to be approved through that service, through the what's it called? Home style.
So
Sorry.
yes, they will have to be approved for that, and we will also get them approved through Embrace.
Okay. So the contractor has to
Yeah.
jump through a few hoops himself
And that's
or herself.
and that's the only added I say time frame is just dealing with getting the approval, finding one, and that's really.
So do they pay the contractor directly, or do they pay the borrower to then turn around and pay the contractor?
No, they'll typically do a draw period after the close of the loan.
Okay.
They'll have a specified time frame which will allow them to complete that work within that time,
Okay.
and the contractor will get dispersed
Directly.
draw payments. Yes, directly.
I've often wondered about that, and that's the
Yeah.
same for a 203K,
Same
right?
for 2 or 3K. Yeah.
Yeah, I've often wondered about that. Thank you for answering
Yeah.
that. So one last scenario. I won't put you through too many phases. Last scenario, a borrower is desiring to purchase commercial property. And I know that your Embrace Home Loans does not do commercial, as in the title, Embrace
Yeah.
Home Loans. It is not commercial
Yeah.
lending. I understand. But maybe you could just shed a little bit of an array of a lender's perspective on what steps that person should take. Even though you're not lending commercial money, how is it different from the home buying? How would a commercial entity or a business who wants to put up their shop somewhere, how would they secure a commercial loan going forward?
So Embrace is purely a residential lender. We do not lend money to the commercial side of the business. However, we do have the resources to put that individual in contact with the right person to help guide them through those next steps and process for them to obtain financing.
Yeah. Is it way different than residential?
It's definitely a different animal.
Okay.
Yeah.
All right. So I won't push you to making an answer for that question. But thank you very much, Ian,
My
for being
pleasure.
here. Ian Shemer with Embrace Home Loans, Caron Kinsey Prideaux, Klein Properties. And I welcome you all for our next podcast that will go into more depth on financial lending, specifically on the commercial side. So stay tuned for that episode. Thank you all very much and happy holidays.